Kitco Mining's special coverage of the Precious Metal Summit is brought to you by Nucor Gold.
Gold has had a series of tailwinds this decade due to inflation, geopolitical concerns, as well as a war with Russia-Ukraine. So what wind is blowing strongest? I'm with Ronald-Peter Stöferle. He is the author of In Gold We Trust. Ronald, welcome back to Kitco.
Thank you very much for having me.
The first half of this year, we saw a steady ratcheting up of interest rates by the Feds and other central banks. How does the fight look to you now in terms of taming inflation?
Well, I think we are very close to the peak in interest rates. Yeah, and I think, to be honest, I think in our sphere, everybody's criticizing central banks quite a lot. I have to say, if you would have told me 1 year ago, when interest rates were at 2.25%, I think, and now we're at 5.5, if you would have told me that you will achieve this, that equity markets will be up, that actually volatility will go down significantly, that even gold is up since then. Yeah, 1 year ago, gold was trading at 1650. Now we're around 1900. I would have said, no, it's not going to happen. So actually, I think in hindsight, the Federal Reserve kind of regained a lot of trust in the market. Doesn't mean that they won't lose it again, but I think so far they've done a pretty good job in finally fighting inflation. We know they were way behind the curve, and the ECB is the definition of being behind the curve. But still, I think inflation will not be the main concern going forward. My take would be that the inflation scare will make room for more of a recession scare. So we're clearly in the recession camp. I mean, I think the biggest financial event of this year was actually the recession that didn't happen. We went from hard landing to soft landing to no landing. So from my point of view, it takes a little bit longer than expected due to the fiscal stimulus that is massive. But I'm definitely in the recession camp, and therefore I think that, especially as we're seeing elections in the United States next year, I think the Federal Reserve probably won't hike again in November, and I think they will start lowering rather sooner than later.
How does it set up for gold?
I think that gold, I mean, many people are somewhat disappointed with the performance of gold. But as I've said, last year at that time of the year, during the Precious Metal Summit, gold was at 1650. Now we're around 1900. It's done tremendously well. Mining stocks, not so much. But I think the current setup that we see is mainly influenced by sort of a new regime where central bank demand is really the crucial driver. So 2022, we've seen the largest central bank buying in history. And in the first half of 2023, we actually saw, I think, the highest number of purchases in the last 20 years. So central bank demand has really become a very, very important driver for the gold market. And, those central bank buying programs, they will stick to it. Yeah, they will continue it. So I think that's here for the long term. On the other hand, we're seeing that for the Western financial investor, which can probably be kind of caught with the numbers of ETF inflows and outflows, we're seeing primarily outflows 2023. So it seems that Western investors couldn't care less about gold at the moment. They're somewhat disappointed, while on the other hand, central banks continue to pile up gold. It's not only central banks in Asia, like China, Russia, obviously, also in the Arabic market, but then also Singapore recently started buying gold, Turkey, obviously, but also European countries like Poland, like Czech Republic, and like Hungary started buying gold recently, which I think is pretty interesting. So from my point of view, we're seeing, if you would have told me, Michael, that real rates would rise that significantly, and we're now, depends how you calculate it. If you calculate it, for example, with 1 year inflation expectations, real rates are at plus 2%. And we always said, we wrote thousands of pages of research about gold, and we said the absolute level of interest of real rates is important, but even more important is the direction and the momentum of real rates. And the fact that we have seen surging real rates into positive territory and the price of gold holding up so well, from my point of view, that's an impressive sign of strength. So that makes me very, very confident.
I think you're leading into my next question, just talking about that Asian buying. But you said in another interview that the West is losing control of the gold price. What do you mean?
Well, actually, recently we've seen quite big premiums in Shanghai, for example. Yeah. So in Shanghai, an ounce of gold is trading above 2,000, and we have never seen higher divergence between prices being paid in Shanghai and in Western markets. And I think this is just one sign of this paradigm shift that we described in this year's report, for example. Now, China and India, just to give you one number, over the last 20 years, they imported 35,000 tons of gold. Just the imports. And then we shouldn't forget that China is also the largest gold producer, and no ounce of gold actually leaves Chinese borders. So I think, first of all, this gold is not coming back. And then on the other hand, it seems like those gold flows, and this trend is going on for quite a while, it clearly shows that we as Western investors should perhaps focus more on what's going on in Shanghai, in India, in Dubai, and less what the investors in the Western world do. And I think this is, first of all, on the central bank side that we described before, but also private investors. And then what's also interesting is that China and Russia are the two most significant gold producers. So I think, travel more to Asia, talk more with Asian investors. I think that's really important for the understanding of the big picture in the gold world.
I think we can call this gold price a nice gold price. But does gold have a marketing problem?
It is a nice price in US dollar terms. It's a fabulous price. If you're a Japanese yen investor, gold has made all-time highs in almost every currency. But what I'm seeing here and what I experience from talking to many generalist investors, institutional players, I would say that gold has a marketing problem, unfortunately. And I think it should be kind of the mission for the whole gold industry to deal with these problems. So first of all, if you talk to generalist investors, they would say, well, actually gold is completely useless, while copper, lithium, to some degrees also silver, are very useful for the energy transition. So this is one part. So actually, I think we have to educate people and inform people that that gold is, and I wrote an article for a Swiss newspaper. Actually, gold is quite green from my point of view, because you only have emissions once when gold is being produced, and then it's basically just sitting there. But it is a big topic. The second big topic is, of course, the ESG topic. We're seeing that many institutional players, they've got problems with investing in mining in general. As I've said, copper and some other critical metals are probably doing better. So I think we're now in kind of a transition period where I think last year politicians realized, and also companies realized, that safe access to commodities is just crucial. Commodities are the basis, the foundation of our industries. So I thought it was very interesting when Rob McEwen, for example, said that Volkswagen employs 16 geos now. I've heard in many conversations here with companies that actually they're being approached by government institutions, by state funds, negotiating offtake agreements and so on. So I think on a political sphere, they lately, but finally they realized, well, actually, also in the Western world, we have to do what the Chinese are doing basically for the last 20 years. Securing access to commodities. But as I've said, the marketing topic when it comes to generalists is mainly about communication. In this year's report, we wrote one chapter about the S of ESG. So actually, the social impact that mining has to communities in rural areas. Schools are being built, very high-paying jobs are being provided, infrastructure is provided, access to clean water, and I think most of the listed companies are doing a really tremendous job in actually contributing to the local communities, but it is not really recognized by mainstream investors. So therefore, I would say yes, the gold industry has a marketing problem at the moment. And just one more point, Michael, I'm sorry for the long answer. If I'm going around here, it seems that I'm still one of the youngest kids here. Yeah. So there's not too much new blood coming in. Yeah. So I think we also have to make it much more interesting, more appealing for the younger generation.
Ronald-Peter Stöferle, one of the top news stories within our space was de-dollarization. And then there was a lot of talk about BRICS. The BRICS had their meeting together and trying to get themselves to move away from the US dollar. The meetings have happened. There's some agreements signed. What were your key takeaways?
I wouldn't say it was a nothing burger, but the expectations were very high. I think especially in the gold community, there were big excitement that there's a gold-backed currency coming out. Actually, it was based on a tweet by the Russian embassy in Kenya, which is not the most reliable source, I would say. So this created this kind of buzz that something big would be announced. I read the whole statement and they basically said, yeah, well, we'll consider new infrastructure for payments and so on. And it will be discussed at the next BRICS meeting, which will take place in Russia, 2024. So far, nothing big has really materialized. On the other hand, I think what's really, really fascinating is the fact that with the new kids on the block in the BRICS, especially Saudi Arabia, United Arab Emirates, and also Iran, they're key players in the energy space. So the BRICS now will be are responsible for more than 50% of all global oil exports, and therefore I think the geopolitical significance of that move should not be underestimated. And it is a little bit, a thing that we are seeing since the Enlightenment and the French Revolution, that, there's new forces coming up and they basically want to destroy the established system, the established institutions and so on. And I think this is like the small brother that is growing up, and it is not really being accepted and taken serious, but they should be taken serious because, that's where the growth is. That's where the better demographics are, lower debt, and also commodities, especially energy.
I've been hearing more from the gold inclined crowd about debt. So looking at debt to GDP ratios, we saw a spike during the 2020 at the start of the pandemic, and that was at 135%. It's leveled off since that time. It's about 120%, I would say. The last peak that we had was around World War II, which would be about 114%. Is debt a particular worry at this particular time right now, Ronald?
For me, probably more than for politicians.
Yeah.
So it seems, my last name Stöferle is Swabian, yeah, and there's the Swabian housewife that is being known for very frugal, and saving is most important for the Swabians. So, but it seems that the Swabian housewife is dead. Yeah. Nobody cares about that anymore, and in the US, we basically have full employment, but still the budget deficit will be roughly 3 trillion this year. Since 2019, the US debt is up by 10 trillion. So those numbers are significant from my point of view. And we're now slowly seeing that, this combination of high debt and rising interest rates is something concerning. If you have a look at what happened in bond markets over the last couple of months, it seems that this will be the third year in a row that treasuries actually made a negative performance. The last time it happened, so as far as I remember, was in 1787, I think. So it is definitely something that is concerning for the bond market and therefore also concerning for the, let's say, a 60-40 portfolio. My take would be at some point, as there's not too much marginal buyers left, it seems that Saudi Arabia prefers buying soccer players at the moment and recycling their petrodollars into other projects, like infrastructure and sports and whatever. I think at some point the Federal Reserve will have to step in. And people tend to forget that it's not only rising interest rates, but also quantitative tightening, sucking out 1 trillion of liquidity out of the market. So actually, it is a pretty interesting setup that we're seeing inflation in many, many different areas. But then on the other hand, we're seeing monetary deflation. And I think, talking to many junior mining companies here, it seems like they're a very good gauge for liquidity streams. Because usually when liquidity starts flowing again, they're the last ones to receive it. But then when liquidity dries up again, they're the first ones to really feel it. Yeah, and you can tell that there's lots of stress in the junior space, and everybody says capital is really scarce. So that definitely matters at some point. And I think that this basically confirms what we said in 2021 in our In Gold We Trust report, where we said it's a monetary climate change. Fiscal stimulus is taking over. Fiscal dominance is really what we should focus more. And therefore, I think it's very, very interesting that, the Western world is very active in fiscal stimulus, while China, which is, not doing so well at the moment. If you have a look at the real estate market, if you have a look at consumption numbers, while China hasn't yet launched a big bazooka. Everybody's kind of waiting for that. So far, we haven't seen anything. And I think at some point they will do it. It will be massive. And I think this should also be a trigger for the commodities market, for the gold market.
Let's talk about China for a second. Maybe if we could separate out the critical mineral side and then also the precious metal side. And then obviously see the impact upon the critical metal side. And it's been kind of one of the most surprising stories. That on top of de-dollarization, it's probably been one of the most surprising stories of this year. You have the property bubble, it looks like right now. Maybe we can call it a property bubble, but they're obviously not going to be consuming more copper. They're not going to be consuming more iron ore. When I was looking at one of the major integrated miners, they were talking about, China's looking so great, but we do have India, for instance, which is a real shift, kind of seeing that within a quarterly. But what is the impact from the slowdown in China on precious metals? What would you see is going to be, how does that affect gold?
So far, we've seen that private demand for gold in China is slightly down. I think it's compensated by the buying program of the People's Bank of China. To be honest, Michael, I'm by far not a China expert yet, but from my point of view, also might be anecdotal evidence. But a friend of mine who worked in China, he said, well, actually, their COVID lockdowns compared to what we experienced, what wasn't fun, obviously, but that was like completely different ball game. So he said, because everybody kind of expected when they opened up, there will be so much catch-up demand. He said, actually, Chinese people are very, very, let's say, cautious, nervous. Also from a psychological point of view, they're not doing very well because they've been locked in for almost 2 years. So, and when you don't have this confidence and this trust in the future, and when you're feeling kind of, uneasy, then you obviously don't really start consuming big time. I think at some point it will come back. The property bubble that is kind of slowly imploding already for quite a while. Lots of measures were being taken already. So far, it doesn't work. But I just don't see Marco Papic, for example. He wrote a piece for the Neue Zürcher Zeitung, where he said that President Xi thinks that he's an Austrian economist because he wants to do some sort of a laissez-faire approach, and let the crisis just happen. I just don't see that. So I think they will continue lowering rates, and there will be, otherwise they would have done an enormous U-turn. I think there will be fiscal stimulus coming. We're not there yet, but it's going to come.
Ronald, mining legend Robert Friedland made some headlines a couple of months ago out of the shows. He's been all in on critical minerals, and he sees like a once-in-generation opportunity that's happened with energy transition, also with all of the government programs that are there and all the support you're seeing. There's the massive ramp up in electric vehicles, what's also happening with energy storage systems. These things are going to be voracious consumers of zinc, of iron ore, of lithium, obviously. Just go down the list. I think there's about 30 of them that are listed on the Canadian critical minerals list itself as well, too. We're at the Precious Metals Summit here. There is all the gold juniors and there's the gold developers that are running around right now looking for types of financings. What's your argument for investing in these precious metal companies as of voting for putting an investment in something that's focused on critical minerals, a nickel play or a lithium play? I mean, isn't that going to be a sure bet?
I think it's two different things. Yeah, gold, from my point of view, is money. It's the hardest money. While commodities, copper, lithium, whatever, it's just a commodities play. Yeah? It's an investment with completely different different aspects to analyze. So the stock to flow ratio is obviously crucial. Gold has an enormously high stock to flow ratio, while copper, oil, lithium, whatever, has very, very small stock to flow ratios. So I think this is really crucial to differentiate. First of all, gold being money, and then on the other hand, all those metals also being much more sensitive to the economy. I mean, copper having a PhD in economics, or somebody said that gold has a professor title in monetary debasement. But I think that it's crucial to differentiate. So we do own both sides, obviously, yeah. But it's important for analyzing, or for forecasting prices. I think that's really crucial. I think when it comes to the commodity space in general, I think it's holding up tremendously well, given the fact that China is doing so poorly. I think in a previous regime, when China really struggled, I think commodities would have traded significantly lower. So I think this is kind of a sign that, first of all, this capex cycle is playing out. We explained it in this year's report. Actually, this massive amount of underinvestment that we've seen over the previous cycle. And it's not as politicians hope, that you push a button and then copper comes out the mine and lithium and whatever. So there's huge time lags involved, obviously. As I've said, now it's been a wake-up call, and I know many companies that really are directly negotiating with government delegates. Yeah. And I think that's a very, very positive development. But it doesn't mean that all the supply problems will be solved over the next couple of years. However, I think what's always important, because there's so many charts that are being shown for, lithium, cobalt, whatever companies, it's always this huge gap between supply and demand. And usually technological innovation solves those problems. So I think, with these enormous amounts of capital that are flowing into the critical metals, into battery technologies, yeah, there will be huge progress when it comes to the technology. They will become much more efficient. There's like for the new batteries technologies, they will need significantly less material. And I think we should not forget what Julian Simon called the ultimate resource, and this ultimate resource is here. So we shouldn't underestimate human innovation, especially when there's lots of capital flowing into the sector. But still, nevertheless, there is a gap. There is this capex cycle. But now, finally, I think many politicians are realizing that commodities aren't something dirty and useless, but actually, as I've said, the foundation of our society, basically.
Ronald, you described that you coming from the Austrian School of Economics. We've had a number of these interviews over the years. I think there's probably been more of a Keynesian bent to some of the policies that have been happening with governments over worldwide. I mean, I think it was the old saw again as well too. Once you're in a foxhole, everybody's a Keynesian as well too. I was interested though, what has been missed? You've had a number of criticisms about the types of policies that governments have taken over the years when we've had these interviews. Tell me though, what has actually been missed by there not being more of an Austrian school bent for the types of policies that politicians and governments have taken worldwide? What has been missed?
That's a brilliant question, and it's a very... We wrote a book about Austrian investing and actually what's...
But don't make it too abstract. I was just wondering, like, what's the impact for somebody's like pocketbook? What would you see that would be different for somebody just in terms of how their economic lives might be organized differently, would you think?
I think the most important part would be that actually this huge gap between the rich and the poor, I think it wouldn't be there. It's called the so-called the Cantillon effect. So that actually the closer you are to money production, the higher leverage you can take and the more you profit from money production. So I think this, and there's fantastic charts basically starting in 1971. This gap between the rich and the poor is growing, massively. And I think this, with the more Austrian approach, I think that wouldn't exist. What you said about Keynesian politics, I think Keynes wouldn't be very, very happy that if that would be called a Keynesian policy, because he said, yes, we have to stimulate, but then, when the economy is growing again, then you have to cut back again. Yeah. So, but this part is being missed by politicians. So, the Austrian School of Economics is very, very diverse, I would say. Yeah, there are many, it's like in the Life of Brian where there are, the scene.
It sounds that's true to form as well, too.
Yeah. So, but I think, we wouldn't see those massive boom and bust cycles, that are mainly being influenced by central bank policy. Yeah. So we, for example, we try to use the Austrian School of Economics as a tool in our toolbox. And we said, we wrote a special paper in 2020, fall 2020. We said, now is the time to slowly raise interest rates, to slowly take the liquidity that was created in the COVID crisis and take it out of the system. Of course, nothing happened in 2021. And then in spring 2022, they realized that inflation is not transitory. But I think with the more Austrian approach, we won't see those big cycles that we're seeing.
Lastly, Ronald, we started the interview talking about all of the tailwinds for gold. We were talking about inflation, we were talking about geopolitical risk, we were talking about war, we were talking about central bank buying. What are some of the key trends that you're looking out or following over the next 12 months?
Well, I think it's obviously, what's going on in the United States with Federal Reserve policy is crucial. As I've said, we've got elections coming up. Usually we crunch the numbers on that, and 12 to 14 months before the elections, the Federal Reserve tends to become more conservative. I think they don't want to, they know that actually we're late cycle. And have a look at the yield curve, have a look at the ISM, have a look at the PMIs worldwide. Yeah, they're in all G7 countries, they're actually coming down. So actually, I think they're well aware of the fact that this aggressive hike in interest rates has effects. So the Federal Reserve, in theory, is apolitical. But then there are, of course, also the establishment. And I don't think that, a candidate like Trump, who is kind of anti-establishment, I would say, should be supported with, very aggressive rate hikes going further. So I think they will rather be on the conservative side going forward. I think, we've seen... I don't think that we'll see rising rates in November. The market is now seeing 25 basis points. I don't really see it. But I also don't see that they're cutting aggressively, unless there is some sort of a black swan event. And I mean, we've already seen in spring what happened in the banking crisis in the United States. We know what's going on in China. We know that Europe is slowing down massively. But without such a black swan event, I think the Federal Reserve will stop hiking and then slowly lower rates again. I think they could move on the QT side, so perhaps change their QT program, and perhaps at some point, because there's just so much supply of treasuries over the next couple of months, perhaps they will become the marginal buyer again. Who knows? And then I think you mentioned the war and obviously inflation and all that, all those topics. But I think and that was something that I mentioned yesterday at my fireside talk with Brent Johnson. I think that gold is, and then we're coming back to the marketing problem. I think it's just a very reliable hedge, and we crunch the numbers. Gold is a very good recession hedge. So over the last recession since 1971, on average, gold was up 9%. Gold works pretty well as an equity hedge. So normally, when we're seeing stress in equity markets, gold tends to perform really well. Gold is a pretty good stagflation hedge. So from this point of view, I think gold as some sort of a portfolio insurance totally makes sense. On the other hand, what I mentioned before, this enormous demand coming from Asian markets, I think this is something, I think Frank Holmes coined the term, the love trade. I think this is something that is completely underestimated. And if you go to Dubai, if you go to Shanghai, I mean, gold is just different there. It's just much, much more important than if you walk around in London or in New York. Gold is everywhere. So, with the growing importance of those countries, I think this love trade is becoming more and more important. And I think this is also sort of a positive message, that we have to deliver in this industry.
Ronald-Peter Stöferle, always a pleasure.
Thank you very much, Michael. Thank you.
My name is Michael McRae here at the Precious Metals Summit in Beaver Creek, Colorado.
Kitco Mining's special coverage of the Precious Metals Summit is brought to you by Nucor Gold.